fundsupermart.com.
What is your expectation of global markets for 2014, and is there any key investment themes that you expect to play out?
I think we're going to see a lot more volatility, so we've got to be cognizant of that. I think we're also going to see probably a switch out of the developed markets more into, again, some selective emerging markets. And I think in terms of themes, we're going to see the cyclicals come back into play. So, for example, they're looking very, very cheap at the moment because of growth fears. One of our funds has actually got a very, very high exposure to mining and minerals. So that's certainly going to be a theme to play out. And thinking about it, probably one more is that I think the income theme has still got room to go as long as the Fed keeps interest rates low.
Do you think the worst is over for Europe, and do you foresee monies to flow towards Europe? How should investors position their portfolios in 2014?
This is the million-dollar question, because I know a lot of people are talking about Europe now. We were also one of the early people into Europe. We've made a lot of money in the last year or two out of Europe. And so the quick answer to your question, is the worst over? I think the answer is yes. I think the worst is over. It's definitely improving. To us, the question is, has that been discounted? Is it already in the price? And when you look at the various valuations, in a lot of markets, that's the case. It is in the price. And when you look at the cyclicals again, they're pretty well up with it. So I'm not sure that theme is going to run much further. When you look around in the Eurozone, though, in Europe, you can still see cheap markets. So Italy's cheap, Spain's cheap. And so we're still playing those markets, but it really is now coming down to specific markets.
How have global emerging markets performed this year, and what is your expectation for this region in 2014? What is required to drive the region's equities?
Yes, good question. There's been a lot of the story, people were switching from the emerging markets into the developed markets, as we both know, over the last year. It wasn't a diverging emerging markets development market per se, I think. It was people were still chasing growth and the price of that growth. Now, as we've already argued, I think in the developed markets, that's starting to run its course. It's not over, but it's running its course. Whereas if you look at some of the emerging markets now, they look cheap, they look attractive. So it really wouldn't surprise me if 2014 was the year that people started to switch back to some of these developing markets. You know, Russia, China, I think, is looking attractive. Even India is looking attractive. So I think there's a lot of potential there for that shift to take place in 2014. Now that was the first part of the question. Now the second part, what drives the GM equities? Well, I think in all cases it's just one of valuation, pure and simple. You see, you've got a case now where the mature markets, the developed markets, their rallies are actually starting to mature. Whereas you've got a case in the emerging markets, and let's take China for example, which are looking very, very attractive. And you've got to say, well, are conditions in China today as bad as they were in SARS, as bad as they were in 27? And if the answer is no, why are we pricing at those levels? So I think all of the emerging markets that we're investing in, and we've got positions in Russia, etc. as well, they are all characterized by the same feature, which is deep value. And so it will be anything that triggers recognition of that deep value, and part of that could be just a recognition that the developed markets are starting to look tired.
Are there any countries or sectors that you are paying closer attention to for 2014, and why?
Well, the big one that I've already mentioned is cyclicals. A lot of our funds, it doesn't matter whether they're China funds or Malaysian funds, or it doesn't matter what they are, a lot of our funds are very heavily focused towards the cyclical stocks because people have been selling those because they were worried about growth. So, you know, we've been buying those stocks that are exposed to growth, such as the consumer discretionaries and things like that. So I think that's probably the major thing that we're actually playing this year.
What about countries or sectors that you are not investing in or avoiding for 2014, and why?
Yes, we're tending to avoid some of the what are coming to be more expensive. So this is our personal take on things. We in our international funds, we don't have an exposure to US equities, for example, because the US equity market's starting to look stretched, especially the cyclicals are looking stretched, the consumer discretionaries in the States looking very expensive. But so we are playing the US, but we tend to play it via the high yields instead. So we would certainly be avoiding that, which I know is different from the rest. We'd probably also avoid still the LATAM markets. Having said that, we do have a Brazil exposure, but the rest we would probably be avoiding.